spreads. There are two kinds of spreads covered here. One is a twisted calendar. It's basically just the reverse of a calendar. So if we look at what a calendar is, what a normal calendar is, in the normal calendar, what we would do is we are going to sell the front month and we buy the back month. And what we are trying to do in that case is to take advantage of a higher time decay in the front month. And when we take such an approach, we've seen the profit and loss graph for a calendar, it's sort of like a tent pole, and we want the stock to stay in some kind of a range. So we're looking for the stock to stay in some kind of a range, and time decay is the primary income strategy. And the unique thing about a normal calendar is that it's going to be Vega and Theta positive. So which means we're going to gain from time decay and we're going to gain from an increase in volatility after we put the spread. So that's your regular calendar. Now, the problems with a regular calendar is sometimes the range of this movement for the stock is a little too narrow. So very often you put a calendar and invariably you have to somehow make an adjustment, and that adjustment point is not too far away. It's very difficult to build a calendar that has a lot of room to play with. So invariably you end up adjusting the calendar and you turn it into a double calendar or you turn it into a directional trade, and the trade starts going a little crazy. Of course, turning a calendar into a double calendar is a very valid adjustment. It's a great adjustment, and that can provide you with the room you need and still maintain the original parameters of the trade, which is the Vega positive and the Theta positive nature characteristics of the trade. But the problem is, you have to adjust it every now and then. And then once you turn it into a double calendar, and if you need further adjustments, then the trade starts getting a little dicey. Of course, you can turn it into a triple calendar or turn it into a directional trade, but it's very hard to understand what your option positions are when you have two short options in the front series and two long in the back series, and all four are going, seemingly in a chaotic direction. And it's very hard to visualize the trade, to conceptualize the trade. And that's the problem with all these time spreads. Because we're dealing with different months, it makes understanding the trade a little bit more difficult. And also, when it comes to adjustments, your adjustments are not very intuitive. And, just like, if you had a spread or if you had a single option, you know very well how you can adjust it, because you can immediately see, okay, what's your delta exposure, what's your Vega exposure, and all of that, and you know where you need to. You can look at a profit and loss graph and tell what kind of an adjustment you need to make. But in a calendar, it's not that simple, because you might think that, okay, I just need to add a long call or I need to add a long put, but what it does to the other Greeks is a little bit more hard to grapple with. So